picking up where we left off yesterday, we have maintenance fees. And a maintenance fee is any fee that the bank charges for having the account. They're called maintenance fees because that's the fee that the bank charges to process all of your transactions and keep track of everything. Only certain accounts will have maintenance fees. Some will have maintenance fees if certain conditions are not met. So like some accounts only charge you a maintenance fee if your balance falls below a certain level, or if you make too many withdrawals or transactions in a month. You know, they'll have conditions. Some of them just have a fee every month no matter what. Some of them have no fee at all. And it varies from bank to bank. And if you talk about like your most basic checking account, from bank to bank to bank, what the fees will be and if there are any will also vary. That's a per bank policy. Interest is paid on the money in your account over a given period of time. So let's say you have an interest earning account. Currently, a high interest rate, sadly enough, would be about 1%. Most of them are much lower than that. Interest rates are really kind of low right now on that end. But what will happen is then they'll take, let's say it's the annual percentage rate of 1%, they'll divide that by 12, and they'll pay you 1/12% every month on the balance, that your average balance in your account. Most checking accounts don't pay interest. Some do. Usually the ones that do have high minimum balances that are required. Okay, your basic checking account is the one that most everybody has. They're the most common type of checking account. There are money market accounts and other kinds of accounts, but your basic checking account is the most widely used. That's because it's the easiest one. It has the least amount of conditions. You just put money in and you take money out. You can just have as many transactions as you want in a month. There aren't limits usually. Most of them don't have a minimum balance required. A few do, but the majority of them don't have a minimum balance. They don't charge for going over a certain number of transactions. They don't have very many conditions. So this is the reason most people will use these. And most of them, if they do have a monthly maintenance fee, it's very low. A lot of them don't even have that though. They won't have a maintenance fee. Then you have your interest-bearing checking accounts, and there are different types of those as well. They pay interest. Usually they pay it monthly, and it usually requires that a minimum balance has been maintained. If you fall below that minimum balance even for one day during the month, generally that forfeits your interest. Again, per bank policy. So different banks have different policies. You have to read the information from your own individual bank. And then on all interest-bearing checking accounts, if you don't meet the conditions that are on that account, you do get charged fees for that. So if the minimum balance is one of their requirements, not only do you lose the interest if you fall below it, but then they charge you a fee on top of it. Free checking accounts require no minimum balance. Usually you don't even have to have very much money to open one, $10 or $20. They charge no monthly fees. And there was a big scandal many years ago, which resulted in the writing of the Federal Truth in Savings Act. The Federal Truth in Savings Act guarantees that if a bank or credit union or something says that it's a free account, it has to be a free account. They cannot charge you monthly fees. They cannot charge you fees for falling below a minimum balance. The only thing they can charge you would be like an overdraft fee, but that's because of something you did. They can't charge you fees just for using the account. So if they say it's free, it has to be free, and you're protected federally by that. So the joint checking account is an account with more than one person on it. Everybody on the account has equal access to the money. So if you have a joint account with somebody, you can't Well, I mean, you can tell them, well, you only have $20 of all this, the rest of it's mine. You could tell them that all you want, but the bank is not going to acknowledge that. If they walk into the bank, they have complete access to everything. So you have equal rights to the money in the account. You also have equal liability to any fees, any overdrafts, any fraudulent things that are done on the account. So just know that going in, everything's equal. Okay, some banks will offer the free checking account, but they offer it as an express checking account. And with an express checking account, you're only supposed to access it electronically. So you're only supposed to use the phone or the computer or the ATM to do your banking, not actually talk to a live person. Usually if you have one of these accounts and it's your free account, if you actually go in and talk to a person in the bank, you get charged for that. If you call on the phone and talk to a person and not the automated system, you get charged for it. But that's how they get around charging the maintenance fees, is by basically not paying any man hours for you to have the account. You do everything through the computer. Now accounts. Now stands for negotiable order of withdrawal. To be honest with you, they're not terribly common, and I don't know a whole lot about the now accounts. I do know that they are a free checking account that pays interest, but they have a lot of conditions to them. And of course, those conditions will vary based on the bank. Usually high minimum balances to get that interest to be paid. But again, varies depending on the bank, but they do pay interest and they don't charge fees. So that's kind of nice. Okay, the Lifeline checking account. I'm sure you guys have heard the commercials on the radio for the Lifeline telephones, and you have to qualify for them based on your income. Well, when you go to open a bank account, they run your credit report. Basically, they're looking for if you've been reported to something called check systems. And check systems, you get reported to check systems if you've had like a bad check, or you owe money to a bank, and then you can't get an account. Well, with the Lifeline account, similar to, they're saying people need to have a cell phone for an emergency. The Lifeline accounts are, people need to be able to have a bank account so that they can pay their bills and function in society. So Lifeline accounts are required by law in a lot of states, not every state. You know, I don't know if Florida has them or not. I could look into that though. But basically, you have to meet their income qualifications. But if you meet those income qualifications, you're guaranteed to be able to get one of these accounts, because it's a law thing. And they have, if they have fees and minimum balances, they'd be very low, or they won't exist at all. So it's a way for people to get a bank account that wouldn't otherwise be able to get one, because maybe the banks in that area, they all have a minimum opening balance. Like you have to have $200 to even open the account. Well, the Lifeline account would be somebody that can't even come up with the $200 would be able to open an account, or somebody that was in check systems or had bad credit would be able to open an account. And then you have the single account. Unlike the joint account, the single account is owned by only one person, and they're also known as individual or sole owner accounts, and nobody else can access the account, unless of course they get your card and your PIN number. But like, they can't go into the bank, they can't call and pretend to be you and get into your account number. They have to have all the information to do that. Your check register is the record of all of your transactions that you keep. Deposits, the O didn't quite show up apparently. Now fix that. There's an O right there. Okay, so the deposits that you've made, checks you've written, electronic transactions, fees, etc. And this is highly recommended. Okay, people don't keep check registers much anymore because most things are done electronically, and so most people don't even have checkbooks anymore. Except for those of us that are old school. Check register, yeah. Yeah, well, I'm going to give you guys some actually today. So the check register's paper, okay? A check register is highly recommended because a check register is you keeping track of what's going on in your account. When you do transactions, they don't always go through the bank immediately. If you write a check, depending on if you have to mail it, it could take up to several weeks before it clears from your account. If you forgot you wrote it, and you go and you look at your balance, and you go, I have all this money, and then you go shopping, but you already spent it, it's not really there. I mean, it's still there, but it's not really there, right? If you have one of those Target Red Card debit cards, they work like a regular debit card, but you get it's the Target debit card instead of your own bank debit card. It takes 3 to 4 days for that transaction to show up on your account.
Why does it take so long?
Because it's the Target debit card has to go through Target corporate and then go to your bank and then come out of your account, whereas your regular debit card goes, the signal goes straight to your bank kind of thing.
You would think it would just go back.
It's processing. Yeah, it's just the processing now. Paying bills online can take several days for it to show up. Making deposits sometimes can take days and days and days to show up because maybe they put a hold on it. So when you go and you look at your account balance, that's not always the accurate number as to how much money you really have. And very many people rely on keeping some sort of mental balance in their head, or just calling and hearing their balance, or looking it up on their phone or whatever, and then get into financial trouble because it wasn't accurate, and then they overspend. And okay, so here's an example. Let's say you forgot you wrote a check for something. Let's say you mailed a bill, and then you go shopping thinking you have more money than you had. And let's say you end up going to a bunch of different places in the mall, and you spend $3.99 at this store and $5 at that store, and then you go to Chick-fil-A, so you spend another $7, and then you go over here and you get some socks and you spend $10, and you spend a bunch of little transactions, right? And maybe one big transaction. So let's say the big transaction hits, and then the check hits, and then all those little transactions hit, but you don't have enough money in your account for them. Each one of those little transactions, $3, $5, $7, is going to cost you $25 to $35 in insufficient fund fees. So you spent $3, but it cost you $38. It's very easy for that to snowball and become a really big debt that you owe the bank that's hard to get out of. It can happen really quickly. So that's why I'm saying a check register is highly recommended. If you go to the bank and you get a deposit slip from the bank, it won't have your account number on it. And they look different over in this area depending on the bank, but this part is pretty much always the same. Okay, so we have a current balance of $2,300. So I'm just going to write that down here because that does not go on the deposit slip. Okay. She deposits a paycheck, a rebate check, and a personal check. All right, so what we do is we put the date on there, and her name is Allison. What's her last name? Baker, okay. And her account number is 12345. Okay, so she's depositing checks. Checks all have to be listed separately. We just made it up.
Oh, I'm looking through it like, oh my God.
No, I said, what's her last name? And Corey said Baker, so I said, okay, Baker.
I thought he found it somewhere.
No, he just made it up. Sorry. He's been been stalking Allison. Okay, so we have the checks. Now she wants to receive $200 in cash. Up here is cash that's deposited. Down here where it says less cash, this is received. Okay, so she wants cash back basically. So we have to add these up. So she's depositing $995.33, but she's getting $200 cash back, so that gets subtracted. So we add, then we subtract, and her net deposit's $795.33. How much will she have in her account? Well, her balance was $2,300. We add $795.33 to it. Yep, that's her new balance. Okay, so this is the check register, like a normal check register that's full length. And you'll notice that the difference between that and the debit card register is that the debit register does not have a column for item number. It does not have a column, separate columns for payments and credits. So those two columns are missing. Otherwise, it's basically the same. The item number is an item number or some sort of like description code that you create, because this is the check register is your check register, right? So you can create whatever you want. Like I put a W for if I go to the ATM and I pull out cash withdrawal, put W, and I put D's for deposit, and then if I write a check, I write check numbers, and then if I use my debit card or the Visa card or whatever, I pretty much don't put anything. I just put the date. But that's my system. You come up with a system that works for you. What you definitely want to do though is if you write a check, you want to record those check numbers. That's very important for two reasons. One, if a check number is missing, like you have 371, 372, and then the next check you write is 374, you know you lost a check somewhere. Either you forgot to write it down or somebody took it or, whatever, but it alerts you that there's a problem and you need to figure it out. And then you might go, oh, wait, that's right. I did write that check for such and such. And then you can put it in and it doesn't get lost that way. Also, it's not as common now, but the most common bank fraud that used to occur, and they made that movie Catch Me If You Can about it, is people would take checks that somebody wrote and change the numbers and the to person on them, right? They would use like alcohol and something else, and they would remove the ink, and then they would change who the check was written to and change the amount it was written for. Did you guys ever see that movie Catch Me If You Can? With he was changing the checks, right? So that used to happen more frequently as people would get a hold of your check that you were mailing, like you were mailing your cable bill. They'd steal the mail and take the check out and then change, and they'd write it out to themselves or another business for a different amount. Well, when you go and check your balance and you see 3271 and it's not written to DeWitt's Auto Body, it's written to like Joe Smith, that alerts you that there's fraud. So check numbers are really important to write down for lots of reasons. Okay, the dates are good. This is the date that you do the transaction. Keep in mind, and it won't match the bank's date always. That's cool. Good teacher. The transaction date here and the date that the bank has, it won't always match. If it's like an electronic debit or something, sometimes it's the same date, but sometimes it's a day or two later. Or in the case of a check, it's like a week later. Case in point, my mortgage payment cleared today. Today is the 13th. I mailed it on the 2nd. So that was an 11-day turnover. you know, but because I wrote it down, I didn't spend the money on something else. Okay. Then you do the description again. It's your check register, so the description is whatever. You don't have to write DeWitt's Auto Body parentheses car repair. You can write DeWitt's car. You know, it's something that will let you know what's happening. Like Target, you could draw a target if you want. You know, it's up to you. But some sort of description so that when you go back and you look at it later, you know what it was for. And then the amounts. This is what you've spent, and this is what you're depositing. Okay, this gets subtracted, and this gets added. Okay. Now on the little check register I just gave you, you've got one column for both of those. So I recommend you do pluses and minuses in front of it, so you know what to add and what to subtract. Okay, so also you can see there's like this shaded bit, little shaded bit. Some people like to do 2 transactions per thing, and some people do 1 per thing. It just depends on how much space you want to save. It's up to you. You know, I could squeeze another thing right here across if I want to. So I'm going to subtract 1721, which is going to give me a new balance. And I'm going to use my calculator because I want to be accurate. I highly recommend using calculators when you're doing money from your checkbook so that you don't make silly addition and subtraction mistakes. Okay, so that balance is 1951.27. You don't have to write in the subtraction and the addition on this. Again, that's personal. I'm writing it in so you guys can see what I'm doing since we're doing notes. The biggest mistake I see on check registers is adding when you're supposed to subtract or subtracting when you're supposed to add. Okay, and this is the balance. This is how much money is in the account. Your account number is more important than your name, and the reason that is because there could be more than one person at that bank with an account that has your name. Now, if you have a really, really unusual name, that's not necessarily the case, but if you have a really, like a common, if your name is Joe Smith or something common, there could be several people at the bank with your name. So the account number is what identifies your account more so than your name. And it appears on every document that has to do with your account. So it appears on your checks, it appears on your deposit slips, and it will appear on your statements, whether they are paper or electronic, and it's the identifier. Your bank statement is, it's about every month. Depending on the bank, they'll either do a calendar month, or they'll do like a 30-day or 31-day or 28-day statement period. It just depends on the bank. I would say the majority of banks do the calendar month, but not all of them. And what they'll do is, let's say they do the calendar month, they include all the transactions that happen between the 1st and the last day of the month. So whether that's the 28th, 29th, 30th, or 31st. 29th, of course, if it's a February leap year. It lists all the transactions. Every check that cleared, every debit that you created, every deposit that you made that has hit the bank during that period of time. And that's the key. It's that have cleared the bank. Yeah, of course. If a transaction, let's say they print your statement out on the 30th of the month and you went shopping on the 29th, but it didn't hit your bank yet, even though you were in that transaction period or that statement period, it won't show up yet because it didn't hit, the bank doesn't know it happened yet. Okay. Your starting balance is the amount of money that is in the account on that first day, and then the ending balance is the amount of money in that account on the last day. Now, again, there's often I'm going to call it like a time warp between the amount of money that you know is in the bank and the amount of money that the bank knows is in the bank, because of the time it takes for transactions to process between when you actually do them and when they actually clear your bank. So when you look at your balance on the first, it may not match what they say your balance was on the first. So that's why we reconcile bank statements, to make sure everything matches. Because you want to catch things. Let's say, for example, the teller, when they were ringing in a deposit, accidentally put it in as a withdrawal. You want to catch that. If they accidentally put in a withdrawal as a deposit, you probably don't want to catch that. But you know what I'm saying. Like, you want to catch these things. Outstanding deposits are deposits that you have made but that have not shown up on the statement yet. So again, back when they did paper statements more, you used to get a statement in the mail. Does anybody get a bank statement in the mail? Do you? Okay. They mail them, if they run the statements on the 30th, they mail them on the 1st. Well, if you made a deposit on the 1st, but they didn't mail them till the 1st, you won't get it till the 2nd or the 3rd, so your deposit won't show up on your statement yet. Or, even if you made a deposit on the 30th, but it didn't clear, so they might not show up. Those are outstanding deposits. So it's deposits you know that you've made, but they didn't show up on the statement. And these are checks that have been written. Or debits. So like a transaction with your debit card or something that have not shown up on the statement yet. So you can have outstanding deposits and you can have outstanding checks. And a check, it doesn't have to actually be a check. It can be an ATM transaction, a debit, an electronic funds transfer, things like that, just debits. Balancing the checkbook is also known as reconciling. And it's verifying that you and the bank agree on how much money you have. Making sure that your transactions and the bank transactions match. So we're going to reconcile this bank statement. Okay. This is oops. This is my typo, apparently. I didn't put the ending balance on here. Sorry about that. So the ending balance is $628.23. And we'll say the starting balance was some amount of money. We don't really need the starting balance for reconciling. So sorry about that. So just add an ending balance there. Okay, these are the transactions on the statement. And if we go to the next page, this is the check register. Now there's this column here. Okay, this column is for things that have cleared. So you check them off. So see how these two are already checked, or these three are already checked off? Those are things that cleared in the last statement. Okay, so what we do is we go back and forth. So we have a deposit for $35. Here's a $35 deposit, we check it off. We have a deposit for $100, $100 deposit, we check it off. A withdrawal, check number 1770 for $158.08. 1770, $158.08. I check those amounts and make sure that they match. And then I check it off. I have 1768 for $46.50. So 1768, $46.50, we're good. 1769 for $74.64, we're good. And then 1765 for $19.50. Okay, good. Now these ones that are not checked off are the outstanding. So we have outstanding checks and an outstanding deposit. Okay. So what we want to do to reconcile the bank statement, we're going to take the ending balance. We're going to add any outstanding deposits. And then we're going to subtract any outstanding checks. And that will give us the revised balance. Okay, so first I need to figure out what is the total of the outstanding checks. Maybe I shouldn't do that. I should write the word checks so it doesn't get confused with the check marks. Okay, I have a $50 one right here, an $18 one, a $29.10, and a $15. Okay, when I add all that up, I get $112.10. And then I have outstanding deposit. I only have one of those, that's $125. So far, okay? My ending balance, which I had you guys write in, was $628.23. Okay. I add the outstanding deposit of $125. I subtract the outstanding checks of $112.10. And when I do that math, I'm going to get the revised balance of $641.13. This balance and this balance need to match. If they match, you're balanced. If they don't match, you figure out how off they are from each other and then go look for the mistake. And the mistake will either be here in your own register or it'll be something that your bank did. Maybe there's a number transposed somewhere. So instead of writing down 29, you wrote down 92. Or maybe you wrote the check for 29, but the bank, when they entered it, wrote down or put in 92 and took out $92 instead of $29. Do you see what I mean? That's the point of balancing the checkbook, is so you can find those mistakes and address them. If it's your own mistake in your own transactions, you just fix it and correct your balance. If it's the bank's mistake, well, then you take your check register, you take the statement, you go and you get it taken care of. Okay, yeah.